Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates LLP. K&L Gates is a fully integrated global law firm with nearly 2,000 attorneys in approximately 40 offices on 5 different continents. I'm in the emerging growth practice group. I work with emerging companies as they grow and scale, and I also work with investors as they deploy capital into those companies. We've got a great panel today. We're going to be focusing on the latest innovations in fintech, and that panel is composed of Caroline Broder, who's a principal at Crosslink Capital, Simon Wu, who's a partner at Cathay Innovation, Jillian Cohn, who's a partner at Mouro Capital, and Vivek Krishnamurthy, who's brave enough to return to one of my panels, and he is an investor at Commerce Ventures. Now, I'm going to let the panelists introduce themselves and tell you a little bit more about themselves in a moment. Before I do, I'd like to chat and let you know sort of how today is going to be run. So first couple of ground rules. Today's event is recorded, which is terrific. So if you miss some or all of it, so long as you've registered, you'll get a chance. We'll send you the copy of the recording in a couple of days. Now, that of course means that if you pose a question to us and we answer it, please don't put any confidential information in that because that's going to be preserved, on the internet potentially forever. Another note is that I am running the tech in the background and the chat feature is not working today, so I apologize for that. But I'm running the tech in the background. So if you see me looking away from the panelists or doing something else, please understand it's not that I think what they're saying is boring. It's just I may be working on something. So forgive me there. Today's event, we'll have a panel discussion for about an hour. Hopefully it will be very lively. We got 4 panelists, so I want to try and make sure that they each get enough time to speak. And then we're going to take a half hour at the end for Q&A. Now, as I mentioned, the chat feature is not working at the moment. We'll catch you on the next one on that. So if you've got a question, please use the Q&A function because we will be monitoring that. We're probably going to be taking those questions at the end, and those questions, the answers that we give will be focused on questions that are of sort of general applicability to the audience in the room, which brings me up to my next request. If you haven't already, please fill out the poll because it's great to know who's here. Now, with that in mind, I want to start by having each of the panelists introduce themselves. Maybe we'll, and in introducing themselves, please let us know who you are, what fund you're with, sort of your general background, what vertical or sub-verticals you're in fintech, what types of companies you like to work with and meet. And, if you want to be contacted, the best way to contact you. And with that in mind, maybe we'll start with Caroline Broder. Caroline?
Yeah, thanks, Jason. Thanks everyone for joining. My name's Caroline Broder. I'm a principal at Crosslink Capital. Crosslink is an early stage focused fund. We're based here in the Bay Area, pretty small team of 9. So with our current fund, we invest across businesses in the US and Canada. We're investing out of our 9th early stage fund. So we've been around for a little while. And our core focus out of that fund is leading and co-leading investments at the earliest stages. So typically seed and series A have some flexibility to invest a little bit earlier at pre-seed stages as well. And kind of our core focus is investing in enterprise software and fintech. I spend my time across both of those verticals and teams. So about 40% of any kind of given portfolio of ours spans kind of fintech and insurtech. And it's great to be here.
Fantastic, Caroline. We're excited to have you here as well. Jillian, tell us a little bit about yourself, if you wouldn't mind.
I still don't know how to work Zoom, apparently. Hi, everyone. Excited to be here. My name's Jillian Cohn. I work at a fund called Mouro Capital. Mouro is a fintech-focused venture fund, although we define fintech pretty broadly, and we might get into some more detail around how exactly we define fintech later in the panel. The fund spans 3 regions, although I focus on the Americas, so US and LATAM and Canada. And then we have some team members in Europe that cover Europe as well. And we really look across company life cycles, so we can invest anywhere from seed through growth. although sweet spot for us tends to be Series A and Series B.
Fantastic. Great to have you here. Simon, tell us a little bit about yourself.
Thanks, Jason. Hi, everyone. I'm Simon at Cathay Innovation. We're a global venture capital fund headquartered out in Paris, while I'm based here in San Francisco, helping lead some of our U.S. investment efforts. We're a global fund across actually 4 geos, about 40 people today. We're part of a larger asset management group called Cathay Capital, which manages a couple billion of assets across private equity, venture capital, fund of funds, and a number of other products out there. On the venture capital side, we're only about 6 years old. We just started our 3rd fund that we launched last week, a new $1 billion fund as a multi-stage investor. Historically have been Series A and B, and with the larger fund, have started to do more opportunity deals in Series C as well too. Generalist fund, but I spend most of my time in B2B software and Fintech, having worked with a number of notable companies kind of in our background here. Principally, while I cover the US, we invest globally in Fintech, have a pretty large portfolio of financial services companies from consumer to B2B. And so I've written about it quite a bit on TechCrunch, a number of outlets.
Terrific. Well, we're excited to have you here, Simon. And Vivek, since you're a returning panelist, we'll let you go back. We'll let you go last and perhaps even maybe the longest.
There we go. I'll take it. Good to see you again, Jason. And thanks to everyone for having me. My name is Vivek Krishnamurthy. I am an investor with Commerce Ventures. We're an early stage venture capital fund based in San Francisco. We're about 9 years old. We manage about $300 million across 4 funds. Fund 4 is about 150 of that. And we're investing, I think, a little bit earlier than a lot of the folks on the panel. So we're going from person and presentation all the way to Series B. And so that can be hundreds of thousands of dollars into a pre-seed round, or in the low millions of dollars into a Series B round. I would say we are focused on 3 categories as a fund: Fintech, InsurTech, and Retail Tech. I spend all my time in the first 2 categories, so financial services and insurance, specifically where they intersect with SaaS data and platforms. I'd say we're 70% focused on Fintech infrastructure, so technologies, tools, and data versus actually distribution of financial services. And about 30% focused on actually what a lot of folks think of when they think about financial services, which is insurance companies or banks and things like that. So that's us. Excited to have the conversation.
Terrific. And before we kick off the conversation, I see there's a question. Somebody's asking about the closed captions and asking to turn them off. So those are on, but you can change your settings by clicking on more and then hitting subtitle settings and turning those off if you don't want to see the closed captions. But they're there so that folks who have difficulty hearing what it is that we're saying can follow along and read. With that in mind, what I'd love to do is, we're here to talk today. We're here today to talk about the latest innovation and investment in fintech. I would love to sort of open up the panel discussion by just maybe talking a little bit about what 2021 was for fintech and sort of what you're seeing in the beginning and the first half of 2022. And maybe we'll start with you, Jillian, if you kind of give a little bit of a summary and what you've seen.
Sure. So probably everyone is familiar with the headlines. I guess 2021 was probably a record year, not only in fintech, but in venture capital and in the public markets in general, in terms of valuations getting extremely high, higher than they've ever been, arguably unfoundedly high. In venture specifically, there were a lot of large crossover funds, which are basically funds that don't necessarily traditionally invest in venture, but started to. A lot of those came in really in 2020, but then in 2021, they were really active. And as a result of how big those funds were, I think the investors were maybe a little bit less focused on price and maybe a little bit less focused on diligence, and deals started happening at record speeds and at record prices. And we're in a pretty different market now. I think it's a result of a bunch of the macroeconomic impacts that have happened, which really impacted public stock prices. Those dropped. That has kind of trickled down to private markets as well. And so a lot of those crossover funds that were really active have seen pretty significant markdowns. And I think a lot of people in venture in general are just a little bit more skittish. A lot of them are in a wait and see mindset. People don't know exactly how to price rounds. And so the market looks quite different than it did last year. I think if you talk to people though, you hear a little bit more doom and gloom than you see in the numbers. So like CB Insights, for example, released a report, I guess it was about Q2 2022 funding. And it was much lower than 2021, but I think it was still like the 5th or 6th highest quarter on record. And I think there's a bunch of reasons for that we can get into. But that's, I guess, sort of laying the backdrop. I don't want to talk for too long, but that's kind of the overview.
No, that's terrific. The panelists, feel free to sort of chime in and you know, share your perspectives.
Yeah, I think the only other thing I'd add, just at a very high level in terms of what we kind of saw happen at 2021, a lot of the impact I think was seen both on pace of deals being done as well as price. And I think kind of two other factors that kind of contributed to that. The first of which is a lot of kind of newer or first-time fund managers who were kind of starting to invest at the top of the market in 2021. So, you know, amongst these panelists, you have folks in 3rd, 4th, 9th funds who've kind of seen those cycles before, but there was a lot of kind of new capital in the market, in addition to, you know, some of the crossover funds that Jillian mentioned, who are kind of coming down further and further. And I think just in general, a lot of dry powder from existing funds out there. And those pieces have kind of started to shift a bit in 2022, particularly kind of if you think about it from the top in terms of the LPs and institutional you know, funds and their ability to invest in some of these venture capital funds. They're more exposed to the public markets. And that sort of just had kind of a trickle down effect that I think has hit some of the growth stages first. And at least from what we're seeing at the earlier stages is kind of starting to come down in terms of deal pace at the seed and Series A. So I think Jillian said it well, but just kind of two pieces to add in terms of the difference between last year and kind of what we're seeing this year.
I think the other thing I would add is in the lead up, at least in our heads, in the lead up into 21, you know, there's a lot of optimism about what we call kind of like addressable market. And as a lot of new, really interesting fintech innovations came to bear, I think there was a lot of optimism about the magnitude, right? Like, imagine if you could solve 100% of healthcare bill problems around the entire globe, wouldn't that company be worth hundreds of billions of dollars? And I think, interestingly, I don't catch myself any less optimistic about it today, but I think there's been a realism that's been introduced to like the ability to execute on those goals. So I think in 21, folks were really willing to say, hey, if you have the tools, you can go capture the entire market. And so you had companies in the public markets that were trading at 100 times revenues or 50 times revenues. And today, a lot of those businesses are trading at 4 times revenues. And certainly for us, when we look at the market and when you think about the slowdown, I think Jillian mentioned something really valuable, which is like, you know, there's capital sitting around, people are deploying it. I think the trepidation you hear is people just not knowing where prices will end, right? If you thought it was going to be worth $100 billion today, still for sure, you might be willing to pay a little bit higher. But because the public markets are really volatile and because companies are not being given that much credit, even though they're growing well and they have good margins, it's harder earlier in the stage to make those same high conviction bets. So my suspicion is until, certainly as you think about kind of the food chain of kind of private market investing, until the public market kind of gets figured out, I suspect that the earlier stages will continue to be in a little bit of turmoil.
Maybe just exposing or follow up on that math, actually. one of the things when you look at the public markets right now, and I'm not a public market, we're not a public market fund by any means, but I think one of the things, the exercises we do when we're thinking about the exit stage as being a multi-stage investor is just the exit multiple now. What we've seen the first half of the year has just been pure multiple compression, but not necessarily driven, mostly because of price action, which is just demand in this case, and because of interest rates rising, people shifting where their allocations are. And so that shifted quite a bit. We haven't seen the other part of it, which is what we're starting to see now, which is potentially where the earnings may change and what forecasts will believe from a demand perspective of the actual products itself. And so, tagging along what Vivek and Carolyn and Jillian said about the actual demand and optimism of fintech is this actually plays out that the multiples may not be as low, but we don't know what that new multiple number is. Now, if you're historically traded at 40 times gross profit because you're a super high demand fintech company, and now you shift to low single digits, the barometer of what the company can exit at is really hard now. And even if we are somewhere in between the middle of today, which we're starting to base from a price perspective, all the way to the euphoria and potential top end of that, if you're in the middle of that, that still creates such a large amount of volatility in terms of your spread of exits, which means that each stage before, someone has to make the bag a little bit smaller, which means, you thought you were 5 billion or you thought you were 3 billion, now you're 1 billion because there's 3 times less. And then the 1 billion has to be getting in at 300 to make the math work from an entry valuation perspective. 300 has to get to 100, et cetera, et cetera. That's really hard from a trickle down perspective, because if everyone goes all lower and you're paying someone with a presentation and an idea, 15 pre, 20 million pre, that everyone expects a certain level of markup. And if you work backwards to that as a founder, then there's this whole equilibrium imbalance, because the seed person, the new manager, just invested at 15, 20. They would love to see a 50 million to 75 type for the next round, but no one wants to give them more than 30. And so there's this whole disconnect between price, the bid-ask spread, especially on investing perspective, not just secondaries and then there are other markets on it. That really is why no one can do anything, because there's just, the mindsets are still shifted, right? And so I think that time collaborate, people get a little more, need capital and are willing to look at those terms, because I think there's still a lot of kind of alternatives right now. I think that, we're still in a little bit of frozen market because of that. And maybe if the public markets pick up, which is what we're starting to see last 5-10 days, then maybe, it may creep back in that we can pay up a little bit more. But generally, if we're still in that in between, which is I think most what venture funds predict, then it makes things really hard to do anything when your Series A wants to be somewhere closer to 100 than 50, right?
Can I, sorry,
Go ahead, Jillian.
briefly add on to Simon's point? I think there are a couple other factors also contributing to this holding pattern between founders and investors. So the trickle down effect, exactly as you described, Simon, which ties in a way to dilution, right? Like when founders are raising capital, they're going to take some amount of dilution. And last year, 10% dilution was not uncommon. But in general, over the course of a much longer time frame, 10% is kind of unheard of. But I think a lot of founders have that, say, 10% in their mind now. And when investors are saying, okay, it's going to be 20 because valuations are lower, a lot of founders are like, well, I'm just going to wait until it goes back to how it was last year. And I think no one really knows if it will. And then the other piece kind of compounding that dilution effect is, I think investors want to make sure that companies have substantial runway. Like the pace of raising every 9 months and raising enough capital for a year or 18 months was okay before, but that's not really the case anymore. And so most investors want to see at least 2 years of runway, if not even more. And when you add extra capital needed with a lower valuation, you're really pushing on this dilution point, which I think is kind of just causing more of a standstill, as you mentioned.
I'm really glad you brought that up. So maybe we could take just a quick pause, because I think sort of talking about some of those nuts and bolts, like blocking and tackling issues that founders are going to face, are important. Because as I take a look at the poll and see who's in the room today, starting first with sort of where where folks are, and whether they're in a startup or whether they're a large company. It looks like we've got 40% are first-time entrepreneurs. We've got 15% serial entrepreneurs. 23% are in an early stage company. 4 or 5 and 5, excuse me, total of 10% are basically at a growth stage or mature. We've got close to 10% are venture investors. We've got some folks from academia. So unpacking some of this, I think, is very helpful for a number of those types of people who are in the room. We've got a strong sort of North American presence today in the aggregate, probably almost 80%. But again, this event's getting recorded, and I sort of typically see that after we share the recording, which we will do, in the weeks after that, probably it's about 50-50 US and outside the US. So that is great. I would love to, if the panel has sort of the stomach for it and the interest into it, just maybe sort of unpack or kind of dig in a little bit deeper into the shifting that happened between sort of the end of December 31, 2021, and then maybe Q1 and Q2 as we've closed that, because I think it speaks to a number of speaks to looking ahead, right? As I think Simon mentioned sort of time compression and how it takes time for everybody to sort of unwind and sort of reprice. Maybe I think it might be helpful for the audience to see how it has shifted over those 6 months, and also getting each of your perspectives in terms of how long will it kind of take to get to a more steady state, to the extent that, there ever is one. And maybe we'll pick up with you, Simon. There you go.
Yeah, I'm not sure there's too much more to add, given that. Maybe I'll pass it on to, I think Vivek was just going on mute. Maybe you want to start first?
Or if you want to take it sort of, but like vertical by vertical within fintech, like sort of fintech versus insurtech or whatever, like that I think that would be helpful, just to kind of make a little bit more concrete some of this discussion.
Yeah. Absolutely. We've invested both on the B2B side and the B2C side, and we've invested across both on the consumer side in terms of kind of more consumer-facing distribution, as well as both insurtech versus just general financial services across the board, from neobanks all the ways to buy now, pay later, and all that good stuff. I think right now, at least on the valuation side in the public markets, a lot of it has been indiscriminately just really negative across the board. So even the best in class infrastructure companies like a Marqeta, all the way to some that have very questionable consumer type unit economics and fintech, are all treated the same and unnecessarily unfairly punished on that. But I think we're still fairly bullish on a number of those verticals across the board. And I think it's just a lot of it is built on this expectation of consumer demand dropping. And so everything kind of goes down with that, because some of these are lending to some prime or some of the things that we've seen in other cycles that percolate on there. But at the same time, part of our optimism in fintech is that the technology on the back end is doing a better job this time around, both on the insurance side as well as on the consumer underwriting side of things. And so a lot of the building blocks that have been raising a lot of money around that, that we're super excited about, especially in terms of like embedded distribution and things like that, can help manage some of those unit economics to make a much more interesting story. Probably the last thing I would add on to it, we've also, because I cover B2B software, is that I think some of the more core software, adding fintech features on there into extending LTVs has been a really popular thesis. A lot of people looking at from companies like in construction, like Procore, adding lending and financing, all the way to companies like Toast and a number of the other restaurant verticals offering that as well. And we think those are just levers where everyone expect it to happen overnight and you get this immediate boost. But slowly and surely, we're seeing the consumer behavior start picking that up. So while I think price and just the valuation of things ebbs and flows, there is still a lot of, just like Vivek used, optimism that the consumer behavior and the expectation, we think that the adoption will be part of just the day-to-day usage of this will be really important. Maybe I'll leave some of the other verticals for our friends here, because they all cover it too.
I think the thing that I'd add is that it's kind of, I'll talk about maybe insurance specifically for a second, but I think broadly, there are two things that are happening, right? One is fintech specific and the other is a market change. I think the market generally has said, hey, multiples were ridiculous. They're coming down, inflation has gone up, and that's just how multiple math works. Revenue multiples are inversely correlated with interest rates. So there's probably one more Fed hike coming. So we'll see multiples come down probably one more time. I think almost entirely separate from that, if you look at publicly traded lending and insurance multiples, they got destroyed before interest rates went up, right? And you know, you think of 2015 with Lending Club and on deck, you look at Root, Metromile, like all of these businesses. And I think separate from the downturn in the market, the public market has said, hey, if you are a full stack financial services business that takes risk and you're not good at managing that risk, and the only way you can grow is by taking on bad risk and your margins are bad, you're going to get, your multiple is going to go down considerably. And I think no matter what happens to public multiples with companies like Marqeta or Bill.com or Signified or other stuff, I don't think that's going to change how the world looks at or touches neobanks or MGAs or insurance brokers or things like that. And I think that's an important thing to consider because I think those industries are probably forever changed. I think that the capital stack from seed through kind of pre-IPO has realized that those businesses are treated differently unless they rejigger themselves to be margin oriented and continue to be fast growth. And so I think that's a little bit of a separation. I think separately, Jason, you asked kind of a question about like, well, how has this really manifested? Like if you're a startup and you're a founder, like what does this really mean? What we found is that funding processes are taking anywhere between 2 and 3 times longer. So if you were a company that could have raised a round in 30 days and you were budgeted with your cash and your board about taking 2.5 to 3 weeks to raise a round, we're telling our portfolio companies, if you have to raise right now, first, please don't. But if you do have to raise, expect that it will take you somewhere between 18 and 24 weeks. And that's a great process, right? The second thing that's changed is that the dynamic in which you engage investors is fundamentally different today. Last year, the right way to run a process was to do this really quick auction. You get 8 people into your data room, you tell all 8 of them that other people are looking, you give them a deadline, you say, look, give me a term sheet in a week. And actually that worked really well for a lot of our companies. We see a lot of founders, unfortunately, taking that mentality into 22. And they're having really negative outcomes. In a world where VCs themselves are unsure about their next fund, they're not clear about how their portfolios or companies are doing. Their best performers went public last year, and they thought they'd be blowout funds, or now maybe not blowout funds. Running them into a tight auction process against their friends is not the right choice, right? Relationship oriented, extended time, getting to know them, sharing your business model, proving to them over time that margins are getting better. So I'd say that's the more tangible kind of way we've seen the world work, where processes are just longer now. It's super frustrating for founders, but it is, I suspect that will be the case at least to the end of this year.
Vivek, can I ask you really quickly? I mean, what do you think? I mean, I sort of think the auction process was kind of a little bit of an anomaly as well, sort of similar to the 10% dilution. I think that Caroline had mentioned before. What are your thoughts on that?
I think that the reality is like the best performers will always get ridiculous treatment, right? Even now, I think that if I saw a business that went from 1 to 40 in run rate with 80% margins, I'd gladly enter an auction, right? The reality is like there are different rules for different people. The reality is like that type of business I just described is really hard to build in fintech for regulatory reasons, for practical reasons, for bank MSA reasons. So I think that like if you look like that, you probably don't need this panel. I think things have already worked out quite well for you. For everyone else, I think that you're totally right, Jason. Like it's actually unhealthy behavior, right? And like we all saw the headlines last year about like funds that invested in companies and found out they had a conflict 2 weeks later, or you invested in companies and turns out like the entire back office was a fraud. I mean, that's just what happens when you do 7-day processes. I had this conversation the other day, and like I'll out myself as doing this. When we first started, or when I first started in venture, I mean, we didn't do an investment with at least 5 to 6 customer calls and 5 to 6 management calls. Like it just didn't happen. Like you couldn't make it past committee. Right now, I mean, it's like you commit for period of 21. Like you maybe did, if you were lucky, you did 2 off-list references, and you on the management team, and you like begged for one customer call, and that customer gave you 15 minutes on a Saturday on a Peloton ride, and like you did that deal because it was like the most information you can get. I hope we never get back there again, because I think the outcomes are just fundamentally worse when you invest like that, both for the founder and for the investor. So I think those days are hopefully behind us for the 95% of companies that are great, but like not so obvious on day one. But you'll always have the crazies out there that are performing well and get away with kind of murder.
Can I ask Vivek a follow-up question too? You mentioned that you think investors, public market and all the way down are now kind of recognizing that fintechs have a fin and not just tech. And so they have licensing, regulatory requirements, risk that they're dealing with. You know, I think there was a period probably up through at least the mid 2010s where a lot of generalist funds did not want to invest in fintech for exactly that reason. And then it seemed like there was a few-year period where people forgot about that, right? Fintechs were growing super quickly, it was really hot, and every fund wanted to invest in fintech. Do you anticipate that we might be shifting back towards a more like specialized only ecosystem where some generalist funds will start to pull back from the sector?
It's a super interesting question, and we've been thinking about that a lot, obviously, as a like verticalized fund. I think we used to hear this a couple years ago. The thought was that like at the end of the day, TAM wins, right? So if you're doing $500 million of revenue, like that matters, right? And you can do that as a bank, you can do this as an insurance company. It's actually pretty hard to do that as a SaaS company, getting to $500 million of revenue. I think that like what we've now learned is that quality of revenues matters. And I think the pendulum has probably shifted too far in the public markets, right? Like companies like Remitly are trading for less money than I think they have in the bank account or something crazy. Like there's a couple companies like that are like that, and that's a mathematics violation. And so I think that pendulum will shift back. But the point you raise is really interesting, because I actually think generalist funds for the most part have gotten so large that I wonder if the category with reduced multiples could sustain returns for them, right? I think that there are still many multi-billion-dollar companies to be made in fintech. I have no qualms about that whatsoever. But if you have a $5 billion early stage fund and you need companies to be worth $100 billion for you to move the needle, I think there is a question now where there wasn't before for that few years where we forgot, which is if the best multiple you're going to get is 10 times revenues, like you need to get to $10 billion of revenue to get to $100 billion outcome. So I suspect there'll be a cooling off period for generalist funds that have like pushed the dial on that end of it, where you're talking $4, $5, $6, $7 billion funds. I'm talking mostly about crossovers and like the very largest names that I think we're all thinking about. My guess is it would be harder for them to justify fintech. So thank God. Hopefully prices will come down. But I think I don't know. I'm curious if other people agree or disagree.
Yeah, maybe as a voice in the room as a somewhat generalist fund, as in Crosslink can invest in both consumer and enterprise businesses. We do a lot of software, but consistently about 40% of our investments have been in fintech and insurtech. We have kind of maintained a pretty consistent strategy there, and maintained a pretty consistent fund size as well. But I think Vivek, your comment and your point to quality of revenue became like a bigger and bigger question probably over the past 2 years, where a lot of these generalist funds who were used to software multiples and SaaS multiples were seeing payments revenue and didn't know like what to make of that. And so there's always been a little bit of a conversation around like, what does this revenue actually mean? And from the perspective of a more generalist investor who's more used to just kind of seeing SaaS revenue, to see different, quality or types of revenue, with a fintech, I think caused a little bit of pause, and people maybe got past that and started to value payments revenue a little bit higher, because you saw examples like Toast where 80% of their revenue at IPO was from payments. And so people started to see kind of examples of how those companies can be valued. But I do see that there might be a little bit of a return towards valuing some of the SaaS revenue from some of these larger generalist funds over time.
Yeah, I think I absolutely agree with that. And that's actually part of also the category question too, that, Jason, you started the conversation with, because I think, not all financial services revenue is the same. I don't think you treat payments the same margin as lending. And I think people, got a little caught up thinking that it can all be the same across the board. And secondly, and then that margin question is a huge piece of it, is I don't think investors changed. There's a lot of founders that are like, hey, I'm really disappointed that this raise is so much harder than before, because it feels like the investors changed the sandbox. The game is different now. Before, I just need to show pie in the sky numbers. I get a term sheet here. Now I need unit economics, and numbers work. I think it wasn't the case, because I think there was, one, the FOMO that everyone was talking about here in terms of getting a deal done. But separately, it also comes back to the fact that, unit economics were always part of it. We just never got a chance to look at it, because you kept paying more for less every single time. And so for each round, you were just paying up in order for access, because of this frenzied auction process that created this environment doing it. Now, obviously, founders loved it, got things done to go back to work. Investors were like, I can raise more funds, I could deploy faster, and it all worked out. And so there was, terrible incentives probably across the board that we are probably all helped create this environment. But I think ultimately, the best businesses, what we're seeing in the public markets is, while the weighting system is a little skewed, the best ones are still performing actually, or holding better relative to some of the ones, the business models that we talked about in the past that never didn't make it, because ultimately they were just terrible unit economics business, and capital isn't cheap anymore, and therefore they had to figure it out, and people don't think they'll figure it out because they'll run out of money beforehand. And so what, for early stage founders or seed founders thinking about this is the wedge that you're picking right now sustainable, durable moat that can actually create a business that has unit economics that are sustainable, so that you don't have to, it used to be, okay, if I squint a little bit, maybe, then it squint one round, then it became squinting 3 rounds, and eventually kind of pricing that in all in one go. And so it never changed. I think just the bar of what it took got done better. Now that FOMO's gone, the dust settles, you still got to build a durable business to go to IPO. And so I think that's really what I would say to take home about something like this.
Yeah, so it's actually really interesting you say that. I had a similar conversation with a grumpy founder who was like, "You're cheating." Like we had a gentleman's agreement about this being easy, and I don't actually think I had appreciated, my entire venture career has only been in the good times, right? So fundraising on balance has been relatively easy since 2015, 16, 17. It's gotten a lot easier since then, but it was not nearly as hard as it was in 9, 10, 11. And I think that there was, again, we were talking about this agreement, and the agreement was either you can have your super fancy CEO who's super pedigreed and you sell a really big vision, and you can raise as much money as you want. That's what it used to be. Or you grow north of 300% year over year, and you can raise as much money as you want. Forget about margins, forget about TAM. You can kind of get away with most of it. And now I think you're totally right. It's super multifaceted. You have to have founder market fit. You have to have margin. You have to be scalable. And I actually think now, where weirdly, fundraising did not have to be a core competency of yours before, if you could be one of those categories. I think right now, it's weird to say, but it's you kind of have to build to your next raise, which is not the way it should be. It doesn't feel like that's the right thing, but the reality is capital is going to get scarce for the next 12 months at the very least. And so if you decide you want to build a capital intensive business, probably have to think a little bit more carefully about threading the needle to the next raise. Whereas last year or the year before, just grow, find a way to grow, and the capital will find you. And now you have to be a little bit more pensive 18 months in advance about what your business needs to look like, with still having 8 months of runway left, so you can go out to the market and actually raise and tell a compelling story. And that is not easy. It's really rough for seed and Series A companies for sure.
Can I actually maybe pick up on that? And I think there's a topic that I'd like to talk about, or have the panel talk about, that sort of dovetails on it. And it's sort of focused on the intersection of the process of raising capital, maybe how that's shifted over the last year or two. We've got a sort of a Bay Area based panel, although I understand, Simon. Cathay is based in Paris, but one of the things that I seem to notice in the pandemic was a shift so that it became easier to raise capital no matter sort of where your geography was, and Bay Area investors were investing more throughout the rest of the U.S. and throughout the world. But I'm curious to get everyone's take as to, has that shifted back as things start to slow, or is that has the game changed with respect to that, and the world is sort of flatter for capital flows?
I'm happy to start, since we have two offices in Europe, an office in Singapore, an office in China, and here in San Francisco. And also we have a LATAM fund and Africa fund as well too. And at least at the high level, we talk about the partnership. It's what last year happened was part of Zoom, even though Zoom investing is still very much real. I think we are seeing people retreating back to quality and what they know best, which is coming back to the US if you're a US-based investor. And so a lot of the competitive rounds that we are seeing in Europe or in Asia, actually most of those term sheets are gone now, not just because they're not named your favorite hedge fund or large multi-stage fund, but they're just able now to focus back in the States because it's actually getting easier in the US because everyone was focused elsewhere trying to look for alpha. And secondly, I think those that actually built an office in those regions continue to be there. And so we saw notably a rise in uptake in London, building an office, funds being raised in India and in Singapore, focus on those regions of Southeast Asia. And then obviously the explosion of LATAM that no one can deny, when the pricing of a seed and Series A round was the same as it is in Silicon Valley. It was a really interesting data point that we were trying to get around on there. But I would say when you look at the exits now, and this will be actually something we're really interesting about, most LPs are asking about DPI and return of money. And so the interesting thing is when you look at the other regions right now, no one has actually returned any money back yet relative to US. And that's going to be a very interesting data point that we see over time, because you may have amazing markups, and as private investors have to recalibrate their portfolios and valuations as a founder, it doesn't mean that, hey, if I create a company elsewhere, it's going to slow me down from fundraising, because just like all the other investors said, if you are raising, you're crushing it and you have amazing numbers, money will come to you. But it is an interesting idea, is that the notion of exits in each of those regions in Europe, Southeast Asia, et cetera, while we're all very excited, just hasn't panned out in that way, which kind of slows things down a little bit in terms of how investors can really think about the outcomes and what they can do. But one of the beautiful things that we all subscribe to is that you can build a company anywhere in the world. And that's why we have a fund that has so many offices, because we think founders can do that. And so with more and more cloud technologies, and now remote and hybrid being a core functioning piece, Andreessen just announced they're on the cloud today. That's just one of the things that we really believe, that in the next generation of companies, that there's still going to be amazing companies being built there. Now, do they come back to Silicon Valley to raise money, or investors will go find them? I think the pendulum swung too far both ways, and we'll come back. But I think there is a currency risk that we're seeing. There's geopolitical risk that we have to factor in, and we shouldn't treat everybody the same, which is what historically we've done before on that front.
At a bit of a more micro level as well, as our purview is mostly in North America, historically kind of fund over fund, we've seen going from a majority of our portfolio companies based in the Bay Area to a majority based outside of the Bay Area. That's been like intentional on our part. And if you talk to any investor who was investing in 2021, part of that was because prices got really high for the highest quality investments in the Bay Area. I think if nothing else, 2020 and 2021 proved that, great companies can kind of be built anywhere in the US. Historically, folks considered the tech talent in the Bay Area to be the best. And part of that is because there had been multiple kind of successful outcomes of businesses based here, which kind of fosters more innovation, fosters, the founding of new companies and spinouts from growth stage companies. I think we have seen, at least in our portfolio, a large growth in the ecosystem, particularly in Fintech in New York, and a lot of companies being based there. And there have also been, a few successful outcomes from New York-based companies in the past few years, as well as, an increase in some of the later stage capital of folks investing in New York. So we've seen a bit of a shift in that direction. However, I think that, I'm pretty long San Francisco, long Bay Area. I think this will kind of continue to remain a place where investors exist and where founders will kind of come to raise capital and find talent. But we definitely saw a shift if you look at it from our fund 7 to 8 to 9 to where a lot of our businesses are either based outside of the Bay Area or are kind of remote first.
And in terms of like sort of nuts and bolts, like running a process, like has that changed? I mean, in terms of identifying quality, which is I think something that Simon brought up, and each of you has actually kind of mentioned in various answers and discussion points. But are you sort of finding once again that it makes sense to meet with someone in person? Is that kind of part of the vetting process? And do founders need to sort of get comfortable with that? And does that change also with respect to where they are in the life cycle? Is it sort of a different process for seed or A versus B?
I think that, as Vivek mentioned earlier, like processes have kind of returned to normal in terms of the amount of time it takes to actually raise a successful round. And I think part of the beauty of that, at least from my perspective, is that it gives us as investors the ability to spend more time with the founders. In an ideal world, hopefully that's in person. It's not always the case, but I think it gives, the length of time to kind of raise a round right now gives investors the opportunity to spend more time with founders, which I think is really helpful from both sides of it, from both founder and investor. It's a long-term relationship, and if someone's joining your board, you kind of want to make sure that that's someone you want to talk to and have in the room with you. So I think it shifted from being completely necessary, from us at least, to in 2020, 2021 not really happening, to now being like a really nice to have kind of component to be able to spend time with someone in person and kind of vet that quality.
I've actually found that it varies city by city. I think in San Francisco, just like tactically, on balance, I'm not having in-person meetings with founders. Like maybe I'm doing 2 to 3 of them a week. And if I'm meeting a founder in person, it's normally both my only in-person meeting of the day and that founder's only in-person meeting of the day. Whereas I'm in New York every 8 to 9 weeks now. And there, every single meeting is in person. And it's a little weird if you're in Manhattan and the founder's in Manhattan and you propose a Zoom, it's odd to them. And I think it just varies a lot city by city. I actually don't have a sense of how it is abroad and in others, but I think, and I'd be really curious if other folks in San Francisco are meeting their founders more in person. Our portfolio companies we do, because we'll throw events or there'll be an in-person board meeting, but outside of that, and to be honest, I don't feel like I'm getting any pull from founders. I'm going crazy at home. I would love to meet more people, but I can tell when I request an in-person meeting, I am the only in-person meeting. They're changing out of sweatpants into jeans just for me, and that seems not appropriate.
My experience is exactly the same. I would say vast majority of my in-person meetings occur when I'm in New York, and I'm not spending that much time with people. Especially in the early stages of a process, like first and second meetings are almost always in Zoom if it's Bay Area based.
And it's inappropriate, Vivek, because they should stay in their sweatpants. Is that what you meant?
Of course, it's everyone's God-given right.
Fair enough. I understand.
Yeah,
so we're getting.
It's definitely the same too. But in Europe and in Asia, they all meet in person. Their offices are full again. Everyone's coming in. It's there's a queue. There's a waiting area. It's fully, all the conferences rooms are fully used. Which our office is. I feel like I'm in the office today, and it's I haven't had a founder visit here for a while. They borrowed we have plenty of portfolio companies come and borrow our office for events.
Simon, maybe if I could ask a question on that. Do you think is that I think if you had asked me pre-COVID or mid-COVID, which culture would be drawn back to in the office masochism, I would have said the United States, and I would have thought the Parisians would have figured out something better to do with their time. Do you think it's cultural, or is just like the VC power dynamic relative to startups is different in Europe? So like founders want to meet, or VCs can dictate that founders need to meet them in person, or is it just like cultural where people enjoy being in the office, so they're back?
I think it's more cultural because we did, there's plenty of rounds being done all virtually during COVID across the board. Maybe it's actually probably specific to Bay Area, honestly, because it sounds like everyone here in New York, all want to dress up and go out and meet people. So it's just clearly us lazy slobs here in San Francisco.
At least on the legal side, because I'm in a global law firm, so we've got offices in Australia and Europe and Asia, and obviously throughout the rest of the U.S. It really is. I think San Francisco is a little bit of a standout. I feel like many of the other offices, when I talk to them, everybody is working in the office and going in and doing events. And when I go into the office, it's pretty quiet. So yeah, I think it's a San Francisco thing.
Yeah, there's been the most, I guess, like headlines around high profile businesses shuttering their SF offices, I think more than any other city.
Well, the real estate and the traffic didn't help things, I think, so that's kind of one of the problems. So we have a few minutes left. I think what might make sense to do, well, one is to encourage the audience. If you've got a question, please use the Q&A function. We'd love to hear from you. We'd love to answer some questions of general applicability. Or if you've got a specific question, maybe for a panelist with respect to, their fund or vertical, I think that probably makes sense as well. But I'd like each of the panelists to just maybe spend 30 seconds, if there's any takeaway for the audience. Remember, we've got a lot of new first-time entrepreneurs in here. If there's any takeaway in terms of like tactical, just to borrow Vivek's term, how to approach a raise maybe in the next, let's say 9 months, kind of based on what we're seeing in the market. If you'd share that with him, I think that'd be helpful, as well as, if there's any contact information you want to provide, that's helpful as well. So I'll start with Vivek, maybe, since I just mentioned him, and we can kind of go around. Yeah,
happy to do it. I think that the two pieces of advice I'd give is that maybe three, but like the first is that these things pass, and so I wouldn't view it as doom and gloom as I would have just a new challenge. Founders have different challenges with every period, candidly, and this is going to be the one, at least for the next 6 to 12 months. The second is, I would say, I think there's a cultural shift away from the transactional. And so to the extent that you can start thinking about fundraising well in advance of needing to, and organically building relationships with investors, I would really, really encourage that, regardless of stage. And then the third is that, and kind of what I said before, which is, fundraising is a skill just like everything else, right? You wouldn't go guess your way through your go-to-market, or guess your way through it, without doing any research or asking a friend or whatever. I would recognize that bar is a little bit higher right now. And so whether it's conversations with investors, conversations with founders who have raised through different cycles, I would think of it as a muscle, and start maybe building it over the next few months.
I probably, just to add on to Vivek's point about talking to them earlier, these founders, you guys are amazing at selling and getting your first customers and convincing them. I would treat your investors just the same way and do the same level of content marketing, the outreach, the cadences. It's really similar at the end of the day of building a relationship. And now because of Zoom, you can actually, now the volume of things that come to us are even higher than ever before. Just as a founder, the number of tools of companies reaching out to you to sell is greater than ever before over email. So think of it like that. And then if they're on the other side of it, a really well-crafted cold email never hurts. We're definitely, just for everyone, we are open to cold emails. We've invested in founders that have e-shopped us cold. But I think those that just been, blank spam emails that are canned and really have no relevance, just like when vendors try to sell to you, probably doesn't get a return message back. So I would think of it like that. That'd be the first piece I would say. It's treating it just like a process in that regard. And I think second, whatever time you thought it took that your previous founder friends have told you, I would double that and hope for the best that you don't need it on there. And maybe the third piece, and maybe just because I'm we do A, B, and C, I think, and we have a little more, we get a little more data. I think being really prepared in terms of having your KPIs, your metrics, and your story down, whatever that is, in terms of, there's so much content outside that every VC is writing about what the basics are and what you need to fill, from a data room to a deck and everything in between, that if you do that in advance, it's a good exercise just for you to know your business. But also too, I think it also, some of these, while everyone says, the processes are longer, being prepared and actually having everything really comes out very well. Just like what Vivek said about, fundraising is a skill. It's that same level of preparedness is important. There's so many times when you get an investor really excited, and then you're like, oh, I need to ask for XYZ piece of data, which is in theory, like your P&L or a list of your customers and how much you're selling. Takes you a week to do that because you didn't think about it. It just slows and bogs things down. And it's the case. It's the same thing if you had your MVP out and then the customer's really excited and then you can't get a deal to the line because you have documents or anything ready like that. It's the same. Think of it like that, and you wouldn't want to be caught flat-footed doing that. And so that'd be my very tactical, practical, how to get things done advice.
Yeah, I think Vivek and Simon put it well. I think the one piece I'd add is that, from an investor's standpoint, I think targets are kind of constantly shifting. We talked a lot at the beginning of this conversation about how we're kind of in this in-between period, and folks are in a period of kind of pricing uncertainty. So as founders kind of go out and try to understand from their peers, what it looked like 6 months ago, understand that might have changed. And so, try not to hook yourself too much on what someone else might have seen or what someone else might have done, because those targets are just constantly shifting. And I think that's important to keep in mind. And just to kind of add on to the point that Vivek mentioned, if you have the luxury of time, I think it's better for both you and for an investor if you can try to build a relationship, and you don't want to burn too much of your time that you should be spending building the company, talking to investors that might not be a fit down the line. But if you can spend quality time with 2 or 3 investors early on who have high conviction and kind of like your space and your thesis, that will hopefully turn into a process that is competitive without being transactional. And I think that that's ideal from kind of both parties. So yeah.
I think there's been a lot of great advice from the other 3 panelists. I'll add, I guess, one thing, which is don't forget about the substance of the business that you're trying to get people to invest in. So even at the earliest stages, the more that you can kind of demonstrate that you're solving a real problem, that customers really want your solution, the better. And so if it's B2B, if you can get a couple customers that will be willing to speak on your behalf, if it's B2C, showing growth in users, growth in engagement, I think you can do all of these things around process, but if you don't have the substance of the business there, it's not going to matter. And as we talked about earlier, it's harder to get by with, well, it's a huge market and you have money to spend. And so, yes, I would just focus on that as well as everything that Caroline, Vivek, and Simon mentioned.
Well, fantastic. That concludes the panel discussion portion. We're going to shift over to the Q&A and also maybe a couple other questions that sort of dovetail both with the panel and the Q&A. But picking up on that, we've got a question that sort of relates for the best way for a pre-seed company founder to approach angels and VCs. And I kind of wonder if we could, Vivek, both you and Caroline sort of talked about building organic relationships sort of ahead of time and ahead of the raise. And certainly what I've, the process in 2019 was a little bit different than in 2020 and 2021. And, especially when nobody was meeting in person. Now we are starting to meet a little bit in person again. So maybe if you could share your thoughts in terms of what you're seeing now and also where you think it's sort of headed in this semi-post COVID pandemic world.
Yeah, so I'd say that I think one of the things that folks do wrong, maybe I'll start there, and then kind of what has worked and how I think that's changing over time. I think to Simon's point, cold emails can certainly work. But I think you have to be quick and concise, and you have to find super relevant reasons for reaching out. The second thing that I think founders kind of under optimize is once you have that first conversation, you'll set up like a calendar reminder on your end, and you'll do like, hey, once every 6 months, I'm going to reach out. And I think one of the challenges is, again, like, those update calls work if your business is doing incredible, in which case you didn't need the update call. And so where they don't work is you get on and it's like, oh, nothing much has changed, but we're still building. I think what has worked really well, the first is kind of like, a lot of VCs talk about like building relationships or like warm intros. The reality is actually, I think I look at myself and our firm, like the folks that we love talking to come to us through our own founders. So spend the time with founders that have already taken money from the types of VCs you think you should raise from. And I found that founders are incredibly generous with their time, certainly the good ones. And they're always willing to spend 15 minutes with you or 20 minutes with you. And from there, ask them for who's the best angel, who's the best pre-seed fund, who was the most efficient with your time when you were raising. And there's like a 60% success rate there. You don't know that that person's going to invest in you, but they'll take the call and it'll be warm. And I think that's a hack that I think not enough people take advantage of. And then once you do have that introduction to a VC, I'm a big fan of like in-person meetings that are super nonlinear. It doesn't have to be a cold pitch. It can be explaining your category. I think there is a give and a get in this relationship. Like I love to learn about spaces I don't know about, and chances are I don't know your space nearly as well as you. So we can have a 30-minute coffee or drink or lunch, and you're like, hey, I just want to talk to you about my category. And by the way, like this is one random problem I'm having with my business. Like VCs can't help themselves. Like we will try and solve it. We'll try and introduce you to 6 people. And now you kind of like you're working with them. And I think that cadence, it just takes time, right? It takes a month to go find the founder, another month to go to have a schedule that call with them. And like, that's the reason I'm kind of pointing to like, don't start fundraising when you need to, right? It's just like anything else when it comes to talent, you're keeping those relationships warm for years before you do it. And I think finding an organic way, like maybe, and what I just mentioned is one of many ways, but that's what I kind of have in mind. And I think that will likely be the way of the future, at least for the next year. I don't think auctions are coming back anytime soon.
Vivek, you sort of stole my thunder on that one. I was going to say the introduction that I value the most is a CEO that I work with or founder that I work with saying, hey, you have to meet this person. I've been talking with them about their business, or you need to speak with this person. They're one of the hardest working founders I know. And they're like, really pressing on networking and, meeting with other founders. And if that comes up in my inbox, I'll probably schedule that call like the same week if I can. I just value that a lot. So that's a really, really good piece of advice. And I think building up that kind of peer network is really helpful for investor introductions, but it's really helpful for all the other stuff too. And then the second point that I think Vivek mentioned is some of my favorite processes, in terms of like building a relationship with a founder, start with, maybe a high level pitch, maybe that's on Zoom. If we have the ability to spend time in person, I don't want to hear the pitch again. My favorite way to kind of spend that, coffee or breakfast or drink or whatever is to just bounce ideas back and forth. And to Vivek's point, VCs like to feel like they're helpful and smart. So if you can pose business problems to them that you think they might actually have either a point of view or someone they can introduce you to who would be helpful, those are really fun. And I think it also gives a founder an opportunity to talk about some of the things that are kind of top of mind for them that are longer term. So it's less about kind of like the near term execution and more about things you're thinking about that are further down the line. So in terms of a process, you can, get a investor on board with kind of the high level pitch, then kind of take them on this process of what you look like longer term and kind of bring them back to kind of the fundamentals of the business kind of later on in a process when you're actually fundraising. And I think that's those are some of the processes I've been a part of that I've enjoyed the most because it feels really genuine.
Maybe one random tidbit. There's a platform called Signal that NFX Ventures built. Has a great list of pre-seed investors among seed and many stages, but as a starting point directory outside of Crunchbase or something like that could be helpful for founders too.
I was going to touch on the angel side of things. I think Vivek and Caroline covered, and Simon covered the pre-seed VC as well. I think there's kind of two categories of angels. There's like the very prolific angels, which are almost managing their own funds. And then there's people that have been working in an operating role at a startup. Maybe they're CEOs, maybe they're not, and have made money and like to invest it. And I think the second category might be easier to approach in some cases, because you can kind of take the same tact that Vivek and Caroline were talking about, where you can reach out and be like, hey, I'm interested, I'm working on building a company in the same space as the company that either you built or you work at. Can we just talk about the space? And if you can start to develop more of just a camaraderie and kind of friendly relationship, the opportunity for them to angel invest might come up a bit more naturally than kind of a cold, hey, do you want to be an angel in my business?
Yeah,
And hopefully it's
advisory
good
role.
learning for you as well.
Simon, did you mention something about an advisory board?
Yeah, another easy way, or at least to get people interested in your business too, that doesn't require money, at least in first, is to get them to be an advisory member or in some capacity, and then kind of get them to invest. Or if they get to invest, they're going to be part of that too. Because I think, especially for the second camp, especially if they're part of a company or they're just starting to build out, their angel investments or something they just want to do more on the side. So it could be something that's compelling, and then you can get more than just their money. I think that's the beautiful thing. I think I saw a question about, kind of value add from investors. I think that's kind of where the starting point could be on that front.
I actually, Simon, I think that's a really interesting point. Like, we did this analysis for one of our annual LP meetings a couple of years ago. Before 2018, the average period of time between founding a company and first institutional lead was 36 to 38 months. And I think culturally things have changed, where now I think founders have an idea and the expectation is like, I have my idea, let me go raise $3 million. And that may still be an option. I think there's enough pre-seed funds and super angels out there that you can still do it. But if you catch yourself on your 50th call and 50th rejection, and that's not unusual, by the way, I think that's just the conversion rate. Like, it's okay to say you're not ready for institutional capital. And like Jillian's concept is super, super interesting. We call it the Wikipedia strategy. You go to 5 people in your industry that have Wikipedia pages, and if you can convince them, because they're product people, they'll know your category really well, like, that's all you need. Oftentimes you only need like 25K from 7-8 people to get you to an MVP. And there are ways to kind of hack the system to show momentum. So I think, venture capital is a very specific form of funding for your business. And it is awesome once you are relatively confident you want to go build a 100x business. But I think it's actually unfair to expect yourself to have a game plan and be able to separate a VC from a multi-million-dollar investment, 6 months after you've conceptualized something. It's really, really difficult.
It's your next blog idea, Vivek. I'm waiting for you to write it. I like it.
There we go.
So maybe actually sort of picking up on that in terms of being able, I think it'd be helpful. We've got a question about sort of what is the value add of each of your funds, like relative to, I guess, maybe some of the others. It'd be great maybe if you could share, if there's sort of your unique value proposition of the fund, whatever you kind of bring to the table that perhaps some of the other funds in your space do not. And we could kind of go around the table if you wouldn't mind.
Yeah, I'm happy to start.
Go for it.
So we are typically kind of our first investment is at the seed or Series A. We have a pretty concentrated strategy at those stages. So relative to maybe some other purely seed focused funds, we are pretty concentrated in our portfolio strategy, and thus we're often joining the board and creating a board at the seed or joining the board at the Series A, and kind of remaining board members kind of long term. This is probably the case in terms of strategy for a lot of other funds, but we like to try our best to take kind of a team-based approach. So each of our portfolio companies kind of has 2 or 3 kind of core deal team folks who are their go-to from Crosslink to kind of help them. And we think that, at least we think we're pretty good at helping a company kind of grow up from seed to Series A and beyond. And because we see, kind of both of those stages, and we also have examples of kind of sticking around on the board through IPO, we have the ability to kind of see the full life cycle of an early stage business to a growth business. So that's kind of point A. It does take a lot of work from our perspective, and that's why we do have a little bit of a concentrated strategy in terms of the number of investments we will make. And then the other piece is kind of a networking organization that we have as part of Crosslink, which is called Alpha. And I think that has allowed our founders to have access to, networks outside of just the networks of the GPs at Crosslink, which is most often, kind of the limit of what you might get from a fund. And that's been pretty successful for a lot of our portfolio companies. So I would say between kind of the concentrated strategy and kind of involvement at the board and team strategy, and then kind of through the Alpha network, we've been able to carve out a little bit of a niche there.
I can go next. So we are a fairly small team. We have 6 on the investment team, and then we have a handful of back office folks, a couple of which are specialized also in helping our portfolio companies. So we have basically an in-house engagement team, which really just builds out relationships. Maybe it's similar to your Alpha team, Caroline, but build out relationships within relevant financial institutions. So a bunch of banks, payment networks, insurance companies, and they really help our portfolio companies get plugged in to those organizations. And then the investment team is basically comprised of folks that have worked in fintech and financial services and have been investing for a long time. So we support with, basically anything you could think of across like fintech products, product launches, helping raise debt capital, helping on the regulatory side. So basically anything kind of fintech specific. And then also in terms of just like company fundraise strategy, structuring the board, negotiating for future fundraisers, a lot of that stuff. What we do some of with our current network, but less of, which a lot of like big platforms do, is, we don't have an in-house talent network that's going to help you hire your 7th junior engineer. What we do on the talent side is much more targeted and more kind of network driven. But I think that's also what you get from like a smaller, more specialized fund than a larger generalist platform.
Sure, I can go next. So I think it's a very interesting question about value add, because I think a lot of firms have started kind of offering what I would say table stakes, or at least trying to emulate a number of others. I think the one adage is probably still true that I made up, is that you can't outshoot the Warriors in a 3-point contest, being Bay Area people here. And so we know a few firms that have devoted a ton into offering and making their VCs more a services firm than just capital, without naming too many names here. And so I think this notion of value add has to be something core to the identity of the firm, and something that frankly all the partners can stand behind and be able to add. And maybe just as a kind of a more general statement, I think for us as a global firm, and more notably a European fund here in the Valley, oftentimes many of the companies we partner with have amazing, early stage investors already that have a very strong Silicon Valley network that already brings to the table at the board level, or just as an advisor to the founder. And oftentimes because of that, I think what we try to bring a differentiated network that complements the company. And so because we're based in Europe, one of the interesting things is 1/3 of our capital base comes from Fortune 500s. These are household brands like Unilever, L'Oreal, Michelin, to technical fields like Sanofi and biotech to CMA-CGM, one of the largest shippers in the world for supply chain logistics, and a number of banks and insurance companies. For at least for fintech here, for example, often they've been really helpful from an idea sharing standpoint. We have dedicated ecosystem or head of platform or head of business development, we call it, where they're kind of connect the dots between some of these large Fortune 500 or enterprise customers, frankly, at the end of the day, to those that are trying to sell to, as well as those that are in the same vertical, often how to navigate certain things, right? We talked a little bit about the fintech, right? A lot of it is regulatory and access, and maybe, in governments, or just even how to navigate some of the scaling problems that many large scale consumer fintech companies face. A lot of them are LPs in our fund and can either offer the capital back end or offer some of the more nuanced regulatory needs in terms of access and things like that, having been a storied player in the space. And that's been pretty helpful, I would say, across the board to some of our companies. And at the end of the day, it's just a huge ecosystem of potential customers or a private kind of expert network, if you will, that our founders can leverage on there. And we focus very much on the go-to-market side of things when we pick a value add, if you will.
So yeah, no, I'm happy to share. Probably to start, I order our office snacks, so they're pretty good if you come through. We have Gushers as of last week. But I'd say beyond that, we're super targeted on a very small subsector of the universe. We focus primarily on fintech and retail tech. Even within that, probably 75% of that is infrastructure. We have 100 portfolio companies. So all of them have gone through if you're an enterprise founder out there and you've gone through the misery of selling to a bank or a broker or a carrier or to anyone else in the B2B motion, we have had the misfortune of kind of being there with you like 99 other times. And I think what we found in this category is that building product is really, really difficult, but what seems to be impossible is distribution. And so what we try to do is partner with any of these three awesome people who are lead investors who can help you build your business and think about board governance and think about kind of the right profile for your kind of VP of Eng. And what we try to do is be an outsourced kind of biz dev hive mind. So we have 8 of the top 20 US banks as LPs. We have 2 of the largest card networks in the world as LPs. We have a number of carriers, a number of brokers, folks in the credit card industry. We have a long tail of individuals and executives who have built most of the businesses in the Fortune 500 that touch it. And the thought is kind of, let's get them super involved in your business to help you scale and go from 1 to 10 to 100 or whatever it might be. And so, yeah, we like to think that we're kind of like fintech distribution nerds that sit alongside your team, kind of small but mighty.
Excellent. So I've got sort of what I would categorize as a follow-up cleanup question. Earlier in the discussion, we were talking about how in 2020, 2021, a lot of the Bay Area investors were looking outside of the Bay, in terms of trying to identify potential investments. And it sounded like there's been a little bit of a pullback. I mean, one of the things that sort of drove that maybe was that the valuations in the Bay Area were particularly high, and it was kind of hard to maybe find an appropriate investment. But we have a question, which is, if you were outside of the Bay Area or outside of the US, like let's say you're in Europe or Asia or Australia, or South America, Latin America, does it make sense to contact US investors? Are they still open to those companies?
Yeah, I know we certainly are, but go ahead, Jill.
Yeah, I was just going to say, I think only if there's some kind of track record of them investing in the region in the past, if they mention it on their website somewhere, if they have a company in their portfolio or a few companies in their portfolio. I think if it's a fund that really 100% of their investments are in the US, then probably they're not looking cross-border. You can reach out to them, but they're probably just going to ignore you or say, sorry, not in scope.
If I can just extract a principle, like a nuts and bolts tactical principle from this conversation, do your research on the potential investors. Simon mentioned Signal earlier. There's Crunchbase. If you've got the ability, and want to do the free subscription, I think you could probably get on PitchBook. The investors, many of them have their own websites. Check them out. Check out their bios if they have blogs. It's all about building a relationship. and kind of understanding and knowing who the person and who the team is going to be critical. So I didn't mean to interrupt you, Caroline. I just, if you had anything to add, but thought that would be helpful for the audience. What we have not touched on, and maybe we'll just hit at a very, very high level, sort of fintech related, is crypto and sort of, blockchain in the fintech space, and sort of any thoughts in terms of what you're seeing, and will we always be in this crypto winter? Who knows? When's the thaw?
I think it's like, the thaw may come, but there's been $10 billion of crypto focused funds raised in Q1 and Q2. That money will find homes. So I think it's one thing if you're a token investor. I'm sorry. I hope your house sale goes well. But I think outside of that, I think if you're building in crypto, and particularly if you're leveraging kind of like true blockchain infrastructure for financial services use cases, there will be capital for you. I think that the broader question is if you're enabling other crypto companies, my guess is there will be a slowdown for some period of time, but blockchain infrastructure for financial services, there's so much capital out there that's looking for a home. I suspect that it will come find you with time.
Yeah, I think I'd add that I think there's just a little bit more of a focus now on why do you need this? I think there was a point of time where a lot of blockchain projects were happening and there was maybe not an immediate application or use case, but it seemed cool and the team was good. I think now there's going to be a little bit more focus on okay, but how are we going to use this? Who's going to use this? What kind of value is it going to drive for its stakeholders?
Makes sense. Let me answer a question just briefly. I'm sure the panelists will all agree. Specifically, should I have a company formed before looking for financing? You're going to need to have a company by the time you raise financing. And you're certainly, if you're talking about raising 50K, you're not raising from venture capitalists. Those would be angels probably at that stage, but you still need to have a company in place, because that's what you're selling. You're selling a piece of the company, you're not selling a piece of yourself. And you also need to be able to tie your customers and all the IP and all that other stuff to your company. So that's just a basic principle that certainly applies here in the US and everywhere else in the world where I've ever sort of encountered. So, and the peril of not doing so is that you may end up with a company with a mess of legal books, can't clean it up, and then you can't get venture investment if that's really the right instrument for you and for growing your business. So contact an appropriate attorney to do that. Sorry, I just wanted to clear that up. Let's see. So maybe I'll ask sort of one high level question in terms of, is there anyone willing to sort of take a bet or a claim as to when we will, how long it will take to understand, have we passed, are we in a recession? Have we passed the recession? And what's the impact on the VC climate market? Is Simon, I think, said in the last 5 days, the public markets have sort of picked up maybe, is that the turn, and will things start to right themselves and stabilize, or are we in for another 12 months of uncertainty?
I'm not going to pick a date, but at least I will say a few things that everyone's really worried or thinking through is how aggressive is the rate hikes going to be, or are we at the end, and will the Fed actually pull it back? Is I think a huge thing that will be a huge catalyst coming up. I think also earnings. I think there's a lot of I would say investors that were really spooked earlier that Q2 would be really bad, but now are thinking it's okay. But in just looking at big tech as barometer, beginning of the year, everyone said everything's fine, business as usual, hiring the same pace, and now every single big tech company has now frozen hiring, or reforecasting or previewing that things have to change, right? And so when we look at them, especially homes for some of our companies, if not also just where we're going to pull talent or people wanting to leave and create companies from, it's a very interesting data point to see that, because it changes a little bit of some of the people's risk tolerance and psyches, and their social, or some of the safety nets around that. So I think that may change the influx of entrepreneurs coming out potentially as well. And that's really important in terms of finding the next big superstar.
So we need more data. We need more data to sort of, get everything priced accordingly.
I think this time
There's
maybe more than.
Yeah, sorry, it took a second from when you were speaking, but I can hear you now.
I was just going to say, I think this cycle more than ever before, it feels almost like the macroeconomic environment is decoupled a little bit from venture. And I guess I say ever before, venture isn't a super long industry, but I think we have a lot of dry powder right now. The industry as a whole, maybe also more than ever before, unless you're counting, 6 months ago when the funds were raised. But like Vivek said earlier, like that capital has to be deployed somewhere. And so to some extent, it almost doesn't matter if there is a recession, when, how long, are we at the beginning or the end? Because there's capital that has to get invested in our industry.
I probably had one quick thing to my reading answer, and actually to Jillian's point. I think a lot of the things that people are going to build in fintech and crypto and things like that, not just like, do we need it, but why is it better than what's already been built? Oftentimes we're trying to disrupt someone, or we're trying to, when investors are thinking about how you're going to be the next big thing, is using some of the heuristics of what others have accomplished. And so a lot of fintech has already been well invested and covered. And so while we have the dry powder, we are also looking for the next big idea on why it should be different and why it should change the current status quo. And so, so the founders that, still want to build in fintech, and that's why I think everyone's here in this call or thinking about it. I think that's the one piece, is to answer how your solution is going to be different than what has worked, and what we started seeing how it plays out at scale. A lot of it was hypotheses and theses. We're starting to get the data to actually seeing if these things can work at scale from a wedge perspective, and then kind of scaling from unbundling or rebundling as kind of the term that everybody used the last couple of years. So this is, I think, now another kind of point in time where we all recalibrate and think how fintech can really change the world next on that front.
All right, Caroline or Vivek, anything? Otherwise, we're at 1:29. I want to start and end on time. All right, so with that in mind, I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates. You can reach me if you'd like at jason.gordon@klgates.com, or connect with me on LinkedIn. I want to thank our attendees today, whether you are live or you're asynchronous. Thank you for joining us. We'll be sending you the video in the next few days after it gets recorded. I want to especially thank our panelists, Caroline Broder, Simon Wu, Jillian Cohn, and Vivek Krishnamurthy. You were excellent. I had a great conversation. It was very exciting. And I want to thank Rob Lau at Idea to IPO for organizing. Other than that, I will let you all get back to your board meetings and other partner meetings, and also let you get back to building your great company. Take care. Bye-bye.